Welcome to this segment of GTM Training Shorts presented by GTM Training Institute, your source for comprehensive income tax compliance and tax provision learning and development. My name is Frank Nieves, Director and Practice Leader. Corporate tax can be complex, and understanding its terms and concepts can be challenging. GTM Training Shorts aims to simplify complex content into concise and comprehensible segments. In this short, we will address the question, what is UNICAP? Listen to Matt Gauze, supervisor in our Wayne office, as he explains.
Thank you, Frank. The Uniform Capitalization Rules, commonly referred to as UNICAP, are found in Section 263A. By its nature, these rules generally apply to companies that have inventory, such as retailers, wholesalers, manufacturers, and builders. Thus, UNICAP rules apply to both producers and resellers of inventory. The rules under Section 263A require that certain costs incurred in the production of inventory and expense for book purposes be capitalized as part of the cost of inventory for tax purposes, including all direct and indirect costs properly allocable to property produced when the costs directly benefit or are incurred by reason of the performance of production activities. The otherwise deductible costs are allocated to property produced or acquired for resale during the tax year and then capitalized to inventory to the extent those items remain on hand at the end of the year. A company will generally include the following in inventory on the balance sheet. One being the price paid or consideration given to acquire the property, and any applicable expenditure incurred to bring an item to its existing condition and location, which includes the costs incurred in the raw materials, work in process, or finished goods cycle of inventory. This type of accounting is typically referred to as full absorption costing. To appropriately apply the UNICAP rules for tax purposes, one must understand how inventory is being accounted for US GAAP or book purposes. Information on the book capitalization methodology can be obtained from a review of prior work papers, a company's inventory capitalization policy manual, and interviews with inventory or cost accounting personnel, among other sources. 263A requires certain additional costs to be capitalized into inventory in addition to those already capitalized under Section 471, akin to book costs. UNICAP is sometimes referred to as super full absorption costing. 263A requires all direct and indirect costs allocable to the production of real or tangible property, property acquired for resale, and self-constructed assets to be capitalized into the basis of inventory. The underlying logic for UNICAP is if goods are still in inventory, a portion of the expenses related to the production, purchase, and storing of goods should be capitalized to the inventory and not currently deducted. There are several key exceptions to the inventory capitalization requirements. Here are some of the most common exceptions along with a tax code citation for further research.
For more information on calculating and recording UNICAP, check out our Corporate Income Tax Compliance Fundamentals 2 program, scan the QR code, or email me for additional information or to suggest a future topic. Don't forget to like and subscribe below. Thank you.